Hi everyone, and welcome to the Investor Update. The half-year accounts for the fund have been signed off by the auditors. Clean audit report, no problems identified. And so now it's time to meet up and to walk through those financial statements. I'm going to give you the highlights tonight. The financial statements have been sent out to you via link, or if you elected to get them in print, they'll be in the mail to you soon. I need to start, as I always do, with the disclaimer. Let's work through it together. General advice warning. This information we're covering off tonight is of a general nature only. It does not take into account your objectives, your financial situation, or your needs. You should consider the product disclosure statement issued by Plantation Capital Limited in respect to your investment in the Passive Income USA Commercial Property Fund. Past performance is not a guarantee of future performance, and no earnings estimates are made. Tonight, any discussion to do with forecast profitability, distributions, redemptions, etc. are all derived from unaudited financial projections. Such forward-looking statements, and they're not guarantees of future performance and involve known and unknown risks, uncertainties, assumptions, and other important factors, many of which are beyond the control of me or you or the responsible entity. The responsible entity does not give any assurance that the results, performance, or achievements expressed or implied by those forward-looking statements will actually occur, and investors are cautioned not to place undue reliance on these forward-looking statements. Obviously, with COVID still ravaging around the world, it's sort of hard to have any degree of certainty about much, and that puts a bit of a cloud of uncertainty on top of the already uncertain nature of financial projections. What we're going to cover are the audited financials highlights. We'll look through the P&L, the cash flow, the balance sheet, and also some other bits and pieces. I'll talk about how the fund is performing, the frustrations, the misses, and also the hits where things are going to plan. We'll do a portfolio summary. I want to run you through a couple of properties and show you what's sort of in the shadows. And then we'll do a recap of where to from here with the investing strategy. And like I normally do at the end of my webinars, we will do a Q&A session. Excellent. Well, let's start off with part one and the audited financial statements. Remembering that you should have a copy of these, either a link emailed to you or a print copy, which you'll receive in the mail if you so elected. Or if that's not the case, you can download them at any time from the Passive Income Fund's website under the disclosure area. That and all the prior financial statements are all there for you. Well, let's start with the profit and loss. And our comparative period this time is the 6 months to June 2021 compared with the 6 months to June 2020. And out of the gate, one of the major sources of revenue for the fund is the rent that we receive. And the 6 months to June 2020, we received 7 million, and the 6 months to 2021, we only received 5 million. That's $2 million less. And you might be sitting there thinking, well, what's happened? Is the the number of tenants gone down? Are they not paying rent? And the answer is yes and no. The number of tenants have gone down, but that's not because they're there and not paying rent. It's because we own fewer properties. And we sold a lot of properties last year coming into the pandemic as a risk mitigation strategy, which is why we paid such large dividends last year, or distributions last year, pardon me. And with fewer properties on the books, it means less rental income for us. Last time round, we had what's called fair market value capital gain, so movement in the fair market value. We're actually surprised by the appraised values of our portfolio, and that caused an upwards revaluation of nearly $2.7 million. We haven't done any appraisals this time round. That doesn't mean that we don't think properties have gone up in value. It's just that when we assessed the cost to benefit of doing the appraisals, and we looked at properties where we thought the value would have improved against properties where the value might have slipped because a tenant might have moved out, On the whole, we made the call that there wouldn't have been a material change in value, and so it wasn't worth spending the $100,000 plus to get the portfolio revalued at this point in time. So that means that we don't have any movement in fair market capital growth to put on the books. But you'll see later on that that doesn't mean that there hasn't been capital gains. It just means that they haven't got to the point of certainty where we can book them in the financial statements according to accounting standards. We didn't sell any properties, so there's no realised capital gains. Just a reminder, the realised capital gains of 389 grand in the prior period is over and above that fair market gain bump for that property, so a bit of extra gravy on top. When a property goes up in value, it's first of all reflected in a movement in fair market value, and then above that, you get these realised capital gains. And then you've just got this sludge fund called all other revenue. And when we total it up, we had 10.3 million for the first 6 months of 2020 compared to 6.2 million for the first 6 months of this year. $2 million of that, $3.8 million difference relates to less rent, and another $3 million. So 2 million less rent, $3 million of that difference really relates to us not booking any fair market movement or realised capital growth. That theme will keep coming back. Percentage-wise, that means revenue is down 40%. Our rental income was down 28% because there's fewer properties, which means less rent. And as I mentioned, we haven't revalued any properties coming into the June year end. Why not? Again, the cost to benefit of doing so and spending $100,000 to get someone's conservative opinion on what the properties might be worth just was not worth it in our opinion. And so far, year to date, we haven't sold any properties, but that might change soon, and I'll explain what's going on there. If we look on the expense side of things, we would expect fewer property expenses because we own fewer properties, and that's the case a little bit. I think there's a little bit of structural cost changes going on behind the scenes. It's just going to take a little bit more time to work through. For instance, we have a situation where when we incur property expenses, we bill that back. And we bill that back typically at the end of the year. So there's a timing difference between when we incur the expense and when we book the revenue for common area maintenance. So I think there's just a little bit of a disconnect here, which may right itself a little bit towards the end of the year. I would expect expenses for next year, same 6 month period, to be down. And I would be hoping that that figure would be in the 2 millions moving forward. The finance costs significantly lower. That's because we repaid a lot of debt last year. The RE fees, the money that you paid to me, is down significantly because there's less funds under management. No, that doesn't mean that I work any less hard. I still treat my responsibilities in the fund as the most important thing that I do professionally. And it's just a function of less funds under management that the RE fees fall. And then there's a little bit of other expenses. So our total expenses are down nearly $1 million, predominantly RE fees, lower finance fees, a little bit less property expenses. Down 16%, RE fees down 26%, property expenses only down 5%, as I mentioned. That CAM timing difference between when we incur the expense, like property taxes, insurance, and when we bill it back to the tenant. Another issue that we constantly deal with is the difference between repairs and maintenance and also capital expense. If I have a roof leak, that's a repair and maintenance. We go out and fix it and we bill the tenant for it. If the roof needs some sort of structural replacement, that's when we go and do CapEx, and that's on us. So deciding when something's CapEx and we have to eat it and add it to the cost of the asset and depreciate it, or repairs and maintenance and push it onto the tenant, is always a bit of a grey area in some cases. And so the property expenses may be a little bit high until we apportion that out of R&M and into CapEx. But that should really have all been done coming into June because that's one of our half year end exercises. just saying that there might be some unusual expenses that we've put through as expenses rather than CapEx in the first 6 months, things like recoding car parks and the like. If we look at the profit and loss, as we know, our income is down and our expenses are also down a little bit, which means that our profit before tax of 1.5 million is substantially less than the 4.7 million. And if we look at the difference between those two numbers, which is 3.2 million, and you go back to the movement in fair market value and the realized capital gains, that's more or less your difference. So is the 68% decrease in pre-tax profit catastrophic? Is it something that keeps me awake at night? The answer is not really. Not when you consider that, there you go, we had 2.6 million of fair market value movement last period and 400 grand of realized gains, which is 3 million. So the pre-tax profit down by 3 million is largely explained by us not doing any revaluation or selling of properties. On a net rental basis, like for like, we're actually pretty even. And that leads us to conclude that the operating activities are primarily performing even with fewer properties, which is something that gives us comfort. If anyone has any questions about this, please hold them till the end of the presentation and we'll do it during the Q&A period. Now, these numbers would look a little bit different if we just made one slight adjustment. Later on in tonight's presentation, I'm going to talk to you about how we have one property under contract for sale at the moment, which is 350 Tech Parkway in Atlanta. That property was last on the books, appraised value at 3.9 million, and it's under contract for sale at 5.5 million. So that's $1.6 million above its last appraised fair market value, or 41%. Now, obviously, that's pretty material, isn't it? Pretty dramatic. So if we just added in that one result, which we haven't added into June because the contract is conditional, then all of a sudden that $3 million difference is half bridged in one step. So I don't want you to sort of look at these accounts, or I'd caution you not to look at the accounts and think, oh, wow, revenue's heaps lower. There must be some operational deficiency, because that is not the case, I don't think. And I would tell you if I thought there was. I'm not trying to sugarcoat anything or hide anything. I'm just saying that when you understand the contribution of the capital gains and movement in fair market value to profit, and that we didn't do that for the first 6 months, that really is the difference between the two. And had we have done that, had we have got this offer 4 weeks before when we did, it might well have made it into the accounts, and therefore the result would be looking more like and like. We have our profit before tax, 1.5 versus 4.7. There's a little tax to pay. Now, we pay tax on the profit in the US, and then we can claim a foreign tax credit in Australia for the tax that we've paid in the US. Our fund's a bit tricky because when you look at performance and you look at profit, our profit that we report is usually after tax, and you get a benefit for the foreign tax credit, which sort of sits off on the side. So if we were doing a 10% return and someone else was doing a 10% return, our 10% return is actually better because it's 10% return plus some tax back in foreign tax credits versus someone else that might have just a 10% return. Anyway, the profit after tax of $1 million compared to 3.3 million prior period. Again, the main difference between the two is that fair market value movement and realized capital gains. So the insight from the profit and loss is, as there were no sales or revaluations, our tax expense is lower for the current period and the comparative after-tax profit is lower. Hopefully that makes sense now. If we move on to the balance sheet and we compare the situation as at June 21 against December 2020, our last prepared financial statements, and we look at our property assets, our property values have actually gone up by nearly $3 million. How can that be? If we haven't bought any property and we haven't sold any property and we haven't revalued any property, how on earth can our property portfolio have gone up $3 million without us recognizing a profit? I'll leave you to think about that for a second. Anyone who thinks they know the answer, well, you're welcome to type it in. And I'll call you an honorary accountant if you get it right. Our cash has gone down. We know that because we've been paying cash distributions. Our other assets are rats and cats, which means our total assets are sort of 5 million, more or less, lower, 4.5 million, lower than in December, and that's primarily because the cash has gone down, offset by the property values going up. Right, looks like there's some clever people out there. Some are saying it might be capital works. That would certainly contribute to it, but the insight is that cash is lower after paying the distributions. And I should also say that we've set aside $7.5 million of that cash for the redemption that's currently underway. So how did property values go up when there was no movement in fair market value? The answer is predominantly unrealized exchange gains. And instead of flowing through to the profit and loss, while they are unrealized, they sit in what's called the foreign currency translation reserve, which sort of sits as a quasi-equity account on the balance sheet. And you'll see that in a moment. So yeah, that's some profit to us from the exchange rate going down. That it will be a future profit when it comes time to sell the properties and return that money to investors. Liabilities, borrowings, more or less the same. We did repay some debt, but again, as the exchange rate goes down, our borrowings go up. So we didn't borrow any more money. That's just a foreign exchange glitch, like with the property portfolio. Deferred tax liability, not significant. Again, restating that future tax liability in US dollars into Aussie dollars meant that it went up a little bit. There's some other liabilities out there, but nothing terribly dramatic. Security deposits, etc., which gives us total liabilities of under 30 million. So they've gone down 3 million. What's the insight on liabilities? Well, more or less stable. Our debt facilities, for those of you who wonder whether or not we've got debt maturing soon, the answer is we have no debt due for repayment until June 2025. So that's still some distance away. But if we did repay that debt early, there would be varying penalties from early repayment to sort of 1 to 2% of the property's value to more draconian penalties for the Wells Fargo loan and having to do debt defeasance. That would be expensive. So we can repay that debt if we had to, but my plan is to let that debt just cook and mature, and we'll pay it back when there are low or no penalties for doing so. Our unit holder funds, there were no applications, there were no redemptions between now and December, so that stayed constant. That foreign currency translation reserve has gone up. That's where that profit from the exchange rate sits unrealized in the balance sheet. It's not really a profit, it's sort of called a reserve at this point in time. And our distributions and profit paid and payable, minus 14,775, which brings us down to total equity of 88.8 versus 90 last period. And that's probably a pretty fair representation of where the fund is, because we've been paying out distributions, but in paying out those distributions, we've got a little bit of profit and we've got that movement in foreign currency translation reserve. Distributions, to remind you, we paid an interim distribution of 6 cents a unit compared to 7.5% for the same period last year. That meant that there was a cash out of 4.74 mil versus 5.93. None of that was allowed to be reinvested. The most recent distribution was paid in July, so that'll be picked up in the year-end financial statements. Overall, there's really not much change in equity, a little bit of change in assets and liabilities, but when you net the two off together, it didn't really make much difference. The foreign currency translation reserve increased as the Aussie dollar weakened. We'll look at that in a moment. And that 12.20 distribution was paid out. So that was a bit of a drain on cash. Speaking of cash, our comparative period is first 6 months of 21 versus first 6 months of 2020. Operating activities from everything except tax went down. That's really a function of less rent received. And then the taxes of 2.757, much higher in the first 6 months to 2021. Why? Because the year-end period in the US is December. And so the taxes that were due on the gains we made last year and had to pay tax on them were paid in January. So that's why the taxes, the cash outflow in paying those US property taxes is a lot higher in this period. That also contributed obviously to cash going down. So our cash flow for net operating activities looks like it's negative, but really it's only negative because of the tax paid on prior period profit. Less properties, less rent, cost structures catching up, which I've mentioned earlier. Leasing commission was a little bit higher than expected as we leased up spaces. We'll talk about occupancy in the not too distant future. You'll see what's going on there. And so that pushed expenses up a bit and we paid those US taxes. Investing activities, minus 366 grand. That's mainly, I believe, the CapEx, I'm guessing. And then the finance activities, minus 6.351 is distributions paid. And that meant that we had less cash, 8.4 million lower than the prior period. Normally, if a business is leaking cash, you start getting a bit worried, particularly if that cash flow from operating activities is negative, because that means that they're not able to increase their cash surplus from operations. But as I mentioned, when you look at our numbers, our operations are actually cash flow positive. We just got around to paying the tax on the prior period profit this time round. So I'm not too alarmed or worried about the minus $1.7 million cash flow from op activities. My investment in the fund did not change between December and June. Like you, I had to take my distributions as cash. The July distribution I reinvested. And the value of my units was pretty stable, which is quite remarkable given the distribution that was paid. So yeah, it's sort of stayed around that $4.2 million invested in the fund. I have much more money invested sort of in the fund indirectly because there's the cash that has to sit in Plantation Capital Limited as a capital adequacy. That's about another $2 or $3 million of cash that has to sit there. So there's a fair bit of my money tied up in the fund, either directly or indirectly. Good, well done if you've managed to hang with me. I know that's not the most riveting thing to get through, the financial statements, but being an accountant, hopefully I've helped explain what's going on and the relationship between the data and what I'm worried about and what I'm not so worried about. I think the expenses for the fund are a bit high, and I'm doing analysis with the team behind the scenes to try and understand the cost behavior of why they haven't come down more. And of course, we're trying to do everything we can to get that revenue figure up, but there's only so much we can do when we have less properties in the portfolio. Anything that I'm dramatically worried about? Nothing out there that, as I said, keeps me awake at night at the moment. What about the fund's performance? You may have seen this slide before. There's three elements to the fund's performance. There's the positive cash flow that comes from leasing activities. There's the capital gains from capital appreciation and value add activities. And then there's the foreign exchange side of things. Let's look at how we're going. In terms of positive cash flow, property is performing. Vacancy is very low. We'll talk about that soon. Rents are up, generally speaking. Every time a tenant renews, I'm seeing between 2 and 10% rental increases. So certainly no discounting on rent. And renewals are very strong, so tenants aren't bumping out. The only time tenants are really bumping out is when they're upgrading to bigger space that we can't help them with. One thing that I am mindful of is that as we sell properties, we have a certain amount of fixed costs, which no matter how many properties we have, we're going to incur. I'll give you an example. audit fees. Whether we have one property or 100 properties, we're going to need an audit. Yes, the bigger the fund, the bigger the audit fee, but we need to maintain a certain number of properties in the portfolio to generate a certain amount of income to pay for the expenses, so we're not drawing down on that cash. And that's one of the reasons why we came up with the strategy and the structure to run the fund out to 2025, because we want to keep that critical mass so we stay positive cash flow, we keep our distributions going, we don't start draining down on our cash and end up in a negative cash flow situation. So I watch this pretty closely, look at the contribution each property makes towards our cash flow pool, and those properties where the cash on cash return starts falling behind, they're the ones that get slated for termination to be sold. Capital gains. I know we hear all sorts of things in the news about the United States of America, Trump, Biden, Afghanistan, COVID. But if we sort of push that out to the side and say interesting but not relevant necessarily directly to our investment, the market in the United States remains amazingly strong and robust. I'm surprised at how good it is. And of course, things could change. There's the specter of inflation. There's what could happen if the US currency drops off, and there's conspiracy theories and non-conspiracy theories and thought bubbles and all sorts of things out there. But if you cut through what might happen and compare it with what actually is happening, and Uncle Zali's wisdom of the phone, our portfolio is at this second performing as well or better than it's ever performed in terms of occupancy and in terms of the low number of delinquent tenants. And that translates to getting superior prices, unsolicited offers, emails from agents saying, can you give us any properties to sell at the moment? We've got multiple buyers. It's the opposite to how things were when we got the fund going. And the anecdotal evidence is that capital growth is expected to continue. And then lastly, we have the Aussie, and the Aussie pushed up to 80, you may remember, and then it's fallen back down to its sort of churn range of somewhere between 70 and 80. And when I looked today, it was sitting at about 73.5. So I know there's a lot of data on this slide. I really have only given you this slide to have in your notes for reference. Last year, the Aussie closed in 2020 at 77.1. At the end of June, it was 75 even, 74.9 something, which means that there was a 2.1 cent movement in our favour, or a 2.7% increase, which is how that foreign currency translation reserve bumped up, which is certainly better than the minus 9.8% that we got last year. So it's one of those rare occasions where the positive cash flow is good and the exchange rates worked in our favour, but we haven't actually had any realised capital gains or movement in fair market value, although anecdotally we think that there might have been some, but we just don't think the cost of getting it independently appraised with all the caveats that come with conservative appraisals would be worth the spend. Looking at the Aussie dollar, for those of you who like to study tea leaves, I am a tea leaf reader. This is going back more or less to when the fund started, and it was sort of pushing parity. Then it fell down, went stable, and then fell down again. And then this is COVID, this big drop, March 2020. Then it went to a recovery, almost where it got up to this sort of head and shoulders type pattern. And then more recently, it's sort of begun another wave down. This, to me, indicates that there's probably pressure on the Aussie going down, or more downside to the Aussie than upside just at the moment. Of course, it's pretty volatile and things can change, but the fact that it didn't get through this resistance level, sort of got close but couldn't push through it, is usually a pretty bearish sign. If we're giving it a pass or a fail mark, we've got positive cash flow. It could have been better, but we sold some of the properties. You'll see here I've given the capital growth a funny looking tick, and that's because I think it's there, but I don't have it on the books to show you. So is something there when it's not there? Well, I'd put a cross there if I was worried the market was going down. So I can't put a proper tick, but it gets a quasi tick. And then we've got a bit of a benefit from the FX feeding through unrealized at the moment through the foreign currency translation reserve. All right, friends, now it's time to do a little bit of education. And I'm going to try and explain performance to you because I'm not sure that people necessarily understand the big picture of performance. And if you do, then what I'm about to take you through is going to be revision. But if you don't, then this will really help you to understand how I look at my investment in the fund and try and weigh up whether it's making the most money in the quickest time for the least risk and lowest aggravation. Remember, I'm not giving you any advice here about what you should do with your investment. I'm sharing with you how astute people would look at the performance of the fund. And to do that, we're going to create a fictitious example and use a simple numbers. That's always good. And scenario number one is where we're going to start is the first half of a financial year. And we're going to imagine that there's 5 cents of profit from rent and that no distribution was paid. So that 5 cents that we got from rent, cents per unit, has been retained. So if we look at the start, so before we even got trading, the first day of the financial period, we didn't have any profit at that point in time. We didn't have any distribution paid out. Let's imagine that we had $105 of assets and we had 100 units, and then that would mean our unit price is $1.05. It's not going to be 5 cents, it's going to be $5 of profit. Sorry, got my cents and my dollars mixed up, but you'll see how this works in a second. So now we get to the first half and we've got a profit of $5. We haven't got any distribution, not 5 cents, $5, my mistake. Now, because we've got that profit, and let's imagine that profit has been realized in cash because the rent's gone into our bank account, that means our cash has gone up, so our assets have gone up from 105 to 110. We've still got 100 units on issue. We haven't issued any more units, which means that our unit price has gone up from $1.05 to $1.10. We can say that the fund's performance has increased because the unit price has gone up 5 cents per unit. Yeah? Do you see that? Yes or no? Can you see how the fund's performance, even though there wasn't a distribution paid, has improved because we made a profit and that profit has been retained in the entity structure and not yet paid out? Excellent. Most people are saying yes. Good. That's where we start. So now we move on to the first half of the year. Summary, no distribution. The unit price went up 5, so $5. So that means our performance is $5. Now we move into the second half. And on those on the recording, I'll just move myself. In the second half, what's happened is that we haven't earned any more profit. Let's imagine that the property became vacant, but we paid out that profit that we earned in the first half. So we've paid out a $5 distribution. Now our assets go back to 105 because that cash has gone out. We've still got 100 units on issue, which means that our unit price, 105 divided by 100, goes back to $1.05. So what has been our performance in the second period? Well, if we looked overall total, now we've got a distribution of 5 cents and the unit price movement of 0 because it's gone back to what it was at the start, which means our performance remains at 5. So performance is a mixture of unit price movement and distribution. So far, so good. Makes sense? Yes? Give me a thumbs up if it does. We're all still with me? Grab a drink. It's about to get a little bit harder. That's the first step in the dance routine. Good. Now we're going to move on to scenario 2. Scenario 2 is a little bit tricky. Now we're going to say that there was, it says cents, but a $6 capital gain from the sale of a property. And we're going to pay out a 15-cent distribution because we're also going to return some capital that has gone from invested in real estate back to cash as part of the sale proceeds. How's that going to impact performance? So not only are we going to have a realized gain from the sale, we're also going to have extra capital that we don't want to retain in the fund anymore. We're going to send that back to investors. Let's have a look. I'll move myself over here. So the first half doesn't change. Now the second half under scenario 2 is the profit is 6, the distribution is 15. So our assets, they were $1.10, they go up to $1.16. You take off the 15-cent distribution because we're paying that as cash. That brings our assets down to 101, divided by 100 units, gives us a unit price of $1.01. Well, hang on a second. Our distribution has now caused our unit price to be lower at the end of the period than at the start of the period, which is a reflection of the return of capital. How does that look like when we put our performance together? Well, we got a 15-cent distribution. Yeah, we remember that 15-cent distribution, which was part profit and part capital. We're not sure of the mix between the two, but we know some of it was capital, some of it was profit. But we know that the unit price went up 5 cents in the first half, down 9 cents in the second half, which meant minus 4 cents overall. So our performance, when you net the two off against each other, was $11, or however you want to put it in your language. Now this is the important bit. If we just looked at the unit price movement for the period, what would we conclude? If we just looked at the unit price movement, what would we conclude? Well, we would say that the investment hasn't performed because that unit price has fallen. But that wouldn't be accurate, because what we're not understanding is the profit that's being distributed out to investors in the form of that gain. And so for those of you out there who are just looking at the unit price movement and going, oh, the unit price is going down, you're right, the unit price is going down. And sometimes it goes down because the Aussie dollar goes up. But the main reason why it goes down is because we are distributing out the profits that are realized as properties get sold. Now, let's see how much attention you've been paying. As the fund winds up over the next few years, and as we sell more properties and return more and more profit and capital to investors, what do we expect the unit price to do? What do we expect the unit price to do? That's right, we expect the unit price will fall. And it's going to fall below $1. And some people are going to say, but I paid $1 for my units. Why is this investment stop performing? And the answer is because we've returned some of that dollar you invested to begin with back to you. We've given you your money back. If you gave me $1 to hold on your behalf, and the very next day I gave you 50 cents back, you haven't made a 50% return on your money. I'm only holding 50 cents of your money. It doesn't mean that the asset's not performing. It just means that you've got less of your capital invested in it. All right. So the insight is that even though the unit price went down in scenario 2, the total performance was nonetheless positive. How is that the case? Because the distribution included all the profit, because we have to distribute all the profit that we get, plus a portion of the capital that you initially invested, which we invested in real estate. Now that real estate is sold, there's no benefit to us holding that money because it's a drag on performance. I think it would be better in your pocket than it would be just sitting in a bank account for the fund. And that's why the unit price will fall below what you paid for the units, not because there's a loss. It's possible that there may be a loss, but the main reason would be because of the return of capital to you. And so you need to look at your investment in the fund in a totality of distribution and unit price. Now, in the financial statements, we do that for you. We put it in the director's report where we talk about cents per unit and the amount that we've paid as a distribution and the amount that the unit price has moved, giving you that net number for the period. So what I've just explained to you is what we do in the financial statements, and you can keep track of as those financial statements come out. So Thomas wants to know, I just saw it in the corner of my eye, so will that likely result in capital loss at the end be made up? There won't be a capital loss, Thomas. It will be a return of capital. There won't be a loss per se. It will just be, instead of getting the dollar that you invested back as a dollar at the very end of the fund, you might get 25 cents back over 4 periods. So you started off with a dollar, then you get your investment's really 75 cents, 50 cents, 25 cents, 0 cents. You can't just think that I invested a dollar, so it's all profit, and then when it's below a dollar, now I start losing money, because that's not the case at all. All right, let's move on, and I'll come back to other questions a bit later. So now what we can do is we can look at this net return, cents per unit, that I mentioned is tracked in the director's report. And you can see here the result. And for the first 6 months, remember it's a half year, we paid out 6 cents in distributions, and the unit price went down 1.11 cents, which means that there was an overall positive profit of 4.89 cents per unit. How does that track with 2020? 2020, we paid out 21.75 cents, but the unit price went down 28.19 cents. So that means there was a negative 6.44 cents per unit outcome. Does that mean that the fund made a loss? Based on what I said tonight, would you say yes or no? All right, Joe says no. The answer is no. What that represents, that 6.44 cents negative, is what? That represents the capital that we retained to you, or that we sent back to you, net of profit, which makes sense because remember that we sold properties. And so when you sell a property, you get all of the amount that you paid to buy the property plus your gain. Well, what do we do with the money that we spent buying the property? Do we leave it in the bank account? No, we paid it back to investors as distributions. So the movement down in unit price acts as a counter lever to the capital amount paid in distributions. So when you offset one against the other, you get the net movement. So this year, what we can say is that the amount that we paid in distributions was largely the profit, but also a little bit of capital that we left in the bank account for a rainy day that we thought that we would give back to you rather than hoarding, which means that the unit price went down, but overall we still added value. All right, happy days. Hopefully this is making sense. Oh, that was a pun, wasn't it? Sorry, dad joke. Now, the all-time 7.5-year return annualized for the fund is presently sitting at 14.85%. That's down a little bit to last year. It was about 15 point something last year. And that just indicates that the fund is still profitable, but it's just not as profitable as what it was. So the overall profitability is gone down a little bit on an annualized basis. I should say that 14.85% is a net of fees result. Often performance is mentioned before fees. We don't do that. That's net of what you pay me for running the fund. And that is not taking into account any of those foreign tax credit bonuses that you were also eligible to receive. So there's a bit of gravy on top of that if you're comparing like with like. So what do we say overall? What's our 2021 summary? Well, the profit, it's stabilizing after those 2020 sales. We have less positive cash flow. There weren't any of those capital gains. Foreign currency gains that were there were largely not realized, so they sat in the foreign currency exchange. Looking forward then, what we say is that the distributions will continue from the net rent proceeds we receive. The realized capital gains, as and when we sell down the properties, hopefully the market will continue to stay strong right through to the end of the fund. And then you will also, in your distribution, not only receive profit, but start receiving more and more of your capital back. And that will be reflected in a falling unit price, which does not prima facie indicate that the fund is making a loss, just that you have less of your money invested in the fund than you did at the start, as your capital has been returned to you. The unit price will increase if and when there's a favorable movement in exchange rate and the assets are revalued. The unit price will fall, however, as we return capital from those property sales. And these aren't going to be independent events. One period you only get one period you only get the other. It may be that in a period you get both. You get realized capital growth, unrealized capital growth, return of capital distribution. So it's going to start getting possibly a little bit complicated. So I expect that the unit price will gradually fall over time as our distributions contain more and more capital, and as properties sell and we return that excess cash to you rather than just keeping it in the fund. Otherwise, if we hang on to the cash, it just means that you end up paying management fees, but that cash is not earning a return. And I would feel bad charging you a management fee for just leaving money in a bank account that wasn't earning a profit. I don't think that would be in anyone's best interests. Yes, we want to maintain some cash reserves because we never want to run out of cash, but it doesn't make any sense to hoard cash. What's the insight then, friends? Don't look at the unit price alone. If you're only looking at the unit price, you're only seeing one side of the story, and it would be easy to make a wrong conclusion about how the fund is going based on only looking at the unit price. In the same way, don't only look at the distribution. That might give you a false sense of euphoria of how the fund is going, because when we distribute profit and we distribute capital, if you don't know the difference between the two and you think it's all profit, you might think things are better than they actually are. The answer is to look at the total return, the movement in the unit price and the distributions and the net difference between the two. Now, of course, as these investor updates continue, I'll be here to interpret what it all means and how we've gone, and obviously here to answer any questions you've got at the same time. On the fund website, we actually put this in a graph format for you, where we track the unit price, which is this bottom one, and we track the total return, which is this top one, And you can see how the total return is dramatically above the unit price, and that is because we distribute out profit. So as we distribute out profit, the unit price goes down because we pay out cash, we have less assets, as explained in the example, but you've got to look at the past distributions to get the total return. So you can look at this as a graph as well. All right. Hopefully that has helped you to figure out what's going on. And like I said, I'll try and get to answer questions at the end. Just bear in mind, I can't give you specific advice about what you should do with your investment in the fund. Part 3, proper portfolio performance. All right, well, there's 3 things I want to bring to your attention here. The first metric is vacancy or occupancy. And obviously our goal is to keep vacancy to a minimum. Why do we want to keep vacancy to a minimum? Because it maximizes our rent and our cash flow. No point having a property sit vacant. It also allows us to recover those common area maintenance costs, the property taxes, insurance, etc. If we have a tenant, if the property's vacant, we have to wear those costs. Think about if you owned a property and it was vacant, you'd have to pay the rates. Commercial property, you couldn't bill the tenant for it. Same with us. And then it also supports higher appraised values having the property leased as opposed to being vacant. Now, par, using a golf term, for vacancy in a commercial setting, in my opinion, is around 10%. So if you're over 10%, it might be a bit of a problem. If you're under 10%, you're doing pretty well. So what is the vacancy in our portfolio right now? So not 30th of June, the latest data that I have available. And the answer here is, if you look to the bottom right of your screen, 9.1%. And this lists all the properties that we own down the left-hand side, and it says the number of units that are in, number of tenant units, if you like, and the number of vacancies. So we've got 8 out of 210 spots vacant. So what's that? 4% vacancy on a number of spots available basis. But if you look at square footage, we're sitting at 9.1% vacant. So that's under the 10%, but really only just. But is there more to this story than meets the eye? And the answer is yes, there is a little bit more than meets the eye. And so we start at 74,739. Then we have to deduct off the shops of Tara shell space, which is space that we have that's not rent ready. And because it's not rent ready, we shouldn't really include it in the vacancy, which gives us this concept of functional vacancy of 66,754. Divide that by the for rent square feet of 813154, again adjusting for that 7985, which is not rent ready, gives us a functional vacancy of 8.21%. But that then also needs to be adjusted for one more reason, and that's because we have 350 Tech Parkway out for sale at the moment with a conditional contract on it. And if that goes through, and the indication is that it will, although it's still conditional, then there's 34,000 square feet of vacant space there, which means that our functional vacancy is really only 32,000 square foot. Divide that by the total square foot space of 759, again adjusting for 350 Tech that's going to be sold, gives us an adjusted functional vacancy at 4.27%. So what looked like sort of 9% is much more realistically or functionally sitting at around 4% if 350 Tech ends up getting sold. And then what you don't know, that I do know, is that we have leases out for completion on 11,000 square feet at Pinellas Park, 6,000 square feet at Pine Ridge Road, and 2,056 square foot of space at Eagle Plaza. And so if that comes off, best case scenario would be sitting at around 2% vacancy. Right, so that gives you some idea of what's happening with the US economy as illustrated by what we're seeing with tenant demand across the tenant spaces that we have. Rent renewal is our second metric, very strong. Rents are routinely being increased by 3% or more on renewal, and we're pushing the standard lease term out to 2 years from 1 year, and not getting much pushback from that because people don't really have very many options on where to go. And then you remember Stu Silver's wisdom of the phone, house price activity. Well, again, we're getting those unsolicited offers coming through. The example of 350 Tech, which I mentioned earlier on in the webinar, last appraised at 3.9 mil. The offer price was 5.2 mil. Through some Steve McKnight negotiation, we got that up to 5.5 mil. And that means that the sale price above the last appraised price is $1.6 million higher, which means a 41% increase of extra profit. How did I get it up an extra 300 grand? Well, that's ultimately why you end up paying your management fees, isn't it? To be able to get that extra gravy on top. And then another example I've got for you is Shops of Tara, last appraised price 7.2 million. Broker's price opinion just received that they think they could get between, or put it on the market at 8.8 and probably get between 8.5 and 8.6. So they're looking at up to a $1.6 million profit above the last appraised value, which would be 22%. So if we added on the Shops of Tara profit and the 350 Tech profit, and those numbers flush through our financial statements, then that drop in profit that we looked at earlier on at the start of the webinar would not exist. So that's why I'm not worried about profit going down, because I have a strong level of confidence at this point in time that there are shadow capital gains vested in the properties that just won't be borne out in an independent appraisal because they're inherently conservative. And we've seen that time and time again when we sell properties. And so there's no point getting appraisals ordered if we're not going to see that value until the portfolio is ultimately sold. All right, so where to from here for the fund? Well, we've got the redemption offer open at the moment. So if you want to exit some or all of your investment in the fund, and you want to do it now, doing it while the redemption period is open would be the way to go, because we only offer a redemption period once a year. It's a fair bit of administration for us to do it. The 2021 redemption offer is open until 5 p.m. on the 30th of the 9th. If you want to redeem, it's a really simple process. You just need to fill in a form, make sure you sign it, and email it to us. The redemption form is available on the website. We have set aside $7.5 million to pay out redemptions. If we get redemptions above that amount, then that's when we can either increase the amount we've set aside for redemptions, or we can look to scale back the redemption offer to the amount of money that we've got available, which is of course what happened last year for the first time. The latest stats on redemptions as of earlier on today were, we've got about 1,000 investors in the fund. So there were 42 redemption requests, and that was approximately 1.65 million units up for redemption. And if we assumed, and remember, we do not know the redemption price until the end of the month, but if we just threw a number at it and said the redemption price was going to be $1.20 per unit, then that would mean about $1.83 million versus $7.5 million set aside. So you tell me, what do we do, assuming we've got millions of dollars more set aside, if the redemption amount is well below that number? Does anyone know what we should do or what you think we would do? Sharon, yes. Leanne, go to Vegas, says Ben. I don't think I'm going to get on a plane to go to Vegas. But yes, you're exactly right. We would pay that out as a cash distribution to investors. Otherwise, if we retained it, it would be a drag on performance. You would pay management fees on it just sitting in a bank account. So that would end up being a return. We could look to buy another property, but with the life of the fund and where prices are at the moment, it's a seller's market, not a buyer's market. I think you guys are doing well to understand the concepts and how it all pieces together. Well done. Just remember that the redemption price is less than the issue price because the redemption price we deduct anticipated selling costs to get the net figure, which is only fair because you're cashing out now as if the portfolio was sold. So we have to deduct what we think those sale costs are going to be. But we don't know what the redemption price as of the 30th of September is going to be until the 30th of September. In fact, we won't know until about the middle of October because we've got to do our month end and put a line under everything and do all the accounting processes and find out what the exchange rate is and blah, blah, blah. And that's a big process. So for those of you who want to know what's the redemption price going to be, the answer is I don't know, because I can't tell you what the redemption price tomorrow is going to be today. I can only tell you what the redemption price is today, and that's assuming I had the data. And because I don't have the data, because we don't do a month end every day, I can only point you to what the redemption price was last month as an indication, and that is published on the fund's website for those that want to look at it to give you an indication. Now, sometimes people say, well, can I put in a redemption form now, and then when I find out what the price actually is, can I then cancel it if I don't like the price? The answer is no, because that's not the way it works. You have to say you want your units redeemed. We honor that, we plan for it, and then when we know the price, we execute it. So it's a bit like making your mind up. And then there usually aren't massive swings in unit price month to month unless there's a really volatile exchange rate. So what is the strategy timeline? Coming back to that, well, we're coming to the end of 2021 and we've got until 2028, which is when we had our vote a couple of years back and said we'd go with the fund. And between 2021, 2022, and 2023, we're going to hold for cash flow and growth, and we're going to spot sell as and when needed, a la 350 Tech. We still aim to do a 6-monthly distribution and an annual redemption. When we come into 2024, though, and starting in 2024, we're going to begin to land the aeroplane. We're going to just slowly drop out of the sky and onto the runway, park at the gate, everyone gets off the plane. So what we're going to do in 2024 is we'll stop doing redemptions, but we'll increase the frequency of the distribution as we sell properties and have more and more capital to give back to you. And then what we do is we keep 26, 27, and 28 in reserve just in case there's an unforeseen event that means that we need to keep the fund going. Now, what if, what if any number of things happen? Well, again, we can always have another vote. We can always decide something else. We can always figure something out. But we need to make a plan for what we think we're going to do, and this is the plan that we've made. And so you need to figure out how your investment objective and horizon fits in with what we're talking about here in terms of our plan, and do, of course, what's in your own best interest to make the most money in the quickest time for the least risk and the lowest aggravation. So what's on the cards? What's on the cards? Well, we're going to do some reappraisals coming into December on select properties, and we'll try and test the market. We won't do appraisals on everything, but we'll do appraisals on some things. One of the properties that we've got remains problematic, New Smyrna Beach. Very difficult to lease up some vacant space there. It's been stubborn. So I've given the team until the end of September to lease it, and if we haven't leased it, we're going to put it on the market to sell. This is the property that we've sold 2 or 3 times, but it's fallen out of contract for one reason or another. So, and I'm working on the possibility of a partial refinance back into US dollars and a significant return of capital as a quasi hedge. We priced up the cost of hedging to protect the currency gains that we've made, and it was just brutally expensive for what it was. So I then went down the road of saying, well, one of the strategies might be to return a lot of capital to investors and just leave the money in US dollar debt against US dollar assets, which is a hedge. Take some of that foreign exchange off the table. But it's expensive to borrow as well, so it's an ongoing task. And that leads us to question and answer. So I'm in your hands right now. If anyone has any questions they want to ask me, hopefully you've been on webinars before and you know how to raise your hand and we can talk through it. Otherwise, I can trawl back through the comments that people have put on the screen and I can seek to answer it. So if you want to ask a question, why don't you raise your hand now and I will come to you. Now, Anne, I know we have this constant problem that your hand's up when it's not up, so I'll assume your hand is down even though it's up. Oh no, there you go, you just popped it down. That worked out well. Let's start with Leanne. Good evening to you. Nice to see you online. Just remember to come off self-mute, Leanne, if you want to have a chat. I'll give you a second to press the button. There you are, I've got you. Hi.
Yep. Hi, how are you? Thanks for that. That was really interesting and thanks for all your hard work.
Oh, you're more than welcome.
I'm so pleased to have been involved with the fund. What I just would like to work out is the unit, the distribution. Is there any way of working out what percentage is capital and what percentage is profit? Because just using the unit price change isn't going to work from how you described. That could fluctuate as well.
Not at the time of doing it, but when we give you your tax statement each year, it splits out the portion of capital and the portion of profit on it. So it is unfortunately confusing because there's one set of numbers for accounting and there's another set of numbers for tax. So what you can do at any point in time is run a performance report to look at your performance in the fund, and that's pretty accurate. Or if you want to see what happened over the year for you, that tax statement is really your best source document.
Okay, because I'm just trying to work out, because we borrowed some money and obviously I want to make sure I'm repaying that out of the proportion returned.
I see what you're trying to do and I think it's astute, but I would look at it differently. Without giving you advice, what I would do is set aside an agreed portion from every distribution as loan repayment, rather than assuming it's all capital or all profit. I would just say X amount of this distribution I'm going to pay off my debt.
Yep. I guess it's just working out what percentage I should make that. I guess if I look back at the previous statements, that would give me kind of a historical average.
Or, I mean, you know, if I was a financial counsellor, perhaps I would ask you, Leanne, why don't you pay all of it off the debt and just get out of debt?
Yes. Well, I guess it's just keeping the repayments going. I'm just trying to work that balance.
I understand. I'm just saying the sooner you get out of debt, the less risk you have. So I'm very low risk. The sooner I get out of debt, the better I sleep at night. So somewhere between 0 and 100% is your answer, but I can't tell you what the percent is. But I can point you to your tax statement to give you some idea of the amount of the distribution that you receive for tax purposes and how much of that should be included on your tax return and how much of that is return of capital / tax deferred.
Yep. Because now reinvesting you into more units, I was trying to work out like the logistics of that now, because you're sort of buying into more capital being returned.
But it's two events, it's not one. It is a distribution of capital and a distribution of profit that you're saying, no, I don't want my capital back. I want to put that into new units where there's no contribution fee. I want more units, but I also want to purchase more units with the profit portion of my distribution. But as you're rightly pointing out, I don't know how much is capital and how much is profit at that time. And in fact, do you see the difficulty? Because the amount of profit and capital at June might be different to the amount of profit and capital at year end. So we don't know
Mm,
what the profit and capital component is until year end for sure, because it can change depending
yep,
on the profitability of the fund. So if, let's say, our profit was 6 at June and was 12 at year end, but we paid out 10 at June, you would think it was 6 of profit and 4 of capital at June, but then by year end, the 10 was all profit. Yeah.
yep,
So
yep.
it's not a finite number until we get to year end, which is why I'm pointing you to that tax statement. It changes.
Yeah. Okay. I'll do some research and some thinking. Thank you.
Okay, excellent. Rightio, Anne actually does have a question. Thanks for prompting me, Anne. I'll come to you right now. Go. Oh, you're self-muted, Anne. You're going to have to click the mute button at your end. Come off
Is
mute.
that
There you
it?
are. Gotcha. You pressed
Is
the
that
right
it?
button. Yep.
Oh, hi Steve. How you going?
Hey,
Yeah,
thanks
just
for asking.
compared to last year, would you say the redemptions will probably be a lot less this year, because last year maybe a lot of us thought we maybe should take back some of our units because of the COVID?
It's a strange thing because we've set aside more money for redemptions this year, thinking that people who couldn't get all their money out last year might want to pop in another redemption. But at this point in time, at least, we've had far fewer redemptions than last year. So it goes to show that you never do know. But I don't know how the numbers are going to end
I
up.
I can understand. Yeah, I can sort of understand that, because I think a few of us probably went into a bit of a panic last year, but things have settled down, so we're maybe thinking a bit more this year rather than just cashing in, because I'm not cashing any in this year.
No,
Yeah.
I mean, it's everyone's right to decide
So
what's best for them. And I never take it personally that someone who may have been a long time client or is even a friend or whatever wants to redeem their money, because it's whatever works for you. It's what's in your best interest. Your best interests are my best interests. So if right now the best thing for you to do is to take your money out, invest it somewhere else, spend it on a new Lamborghini, whatever you want to do, I'm just here to cheer you on. That's my job.
okay, thanks Steve. Yeah, good information tonight. Thank you.
You're welcome. Glad that we could do this update, and good to hear from you, Anne. Thanks for letting me know you did actually have a question tonight. Right, let's go to Jim. Hi, Jim. Nice to see you online tonight. Just remember to come off mute as well, please. There you are. Hi.
Yeah, g'day, Steve. How you doing?
Good to hear your voice, mate.
Um, thank you. Just with respect to the foreign exchange reserve account, am I correct in saying that's a book value based upon the exchange rate at the 30th of June or whatever date you use?
No, well, let me tell you what it is and see whether it aligns with your understanding. What that foreign currency translation reserve represents is profit that we have made net of exchange rate since the start of the fund till now, ups and downs and all the rest of it, that is sitting as a value item on the balance sheet, which will end up being profit as we sell the properties and swap the money back from US dollars to Australian dollars. So it's a profit reserve which will be converted into cash when we sell the properties. But because we haven't sold the properties now, it's not distributable, but sits more or less as the other side of the entry to the higher property values. Remember, in accounting, every debit must have a credit. So if I have a property and I buy, it's $1 million and I bought it when one Aussie dollar bought one US dollar. Yeah. And then let's
Yeah.
imagine the Aussie dollar goes down to 50 US cents. Well, now that asset's actually worth $2 million. because it's $1 million US, but the Aussie's gone down to 50 cents. So if I sold it, I'd get $2 million for it, yeah?
Yes, that's correct. But it's only if you convert the US back to Aussie at that point in time.
Correct, but work with me here. If I had an asset that was worth 1 million, but now on my financial statements, I say it's worth 2 million, so my asset's gone up $1 million, what's the other side of that transaction? How do I account for it? Because if it's gone up by $1 million, there must be another $1 million somewhere I've got to put somewhere. And the answer is I either put it to the profit and loss and recognize it as a profit, but I can't do that because I haven't made it yet. It's unrealized. Or I stick it somewhere else on my balance sheet as an equity item, which is what we do. We put it in the foreign currency translation reserve.
Okay, yep, that makes sense. But in my mind, I still think it's an unrealized profit. It exists as a set of accounting numbers. It doesn't exist as cash in the bank. And because of that, if the exchange rates fluctuate, then the profit may evaporate, or at least
Absolutely. Absolutely. And that's what we saw in 2020 when the Aussie went up, the amount of our foreign exchange currency reserve went down and the amount of our property portfolio went down. So the reserve is designed to be almost like a bit of a seesaw that can go up and down as things swap around, rather than constantly making profits and losses through your P&L.
Yeah, okay.
But it's represented in the unit price already. It's not some shadow profit that hasn't been accounted for anywhere. It's built into the unit price.
Okay, and it's built into the unit price because of the reserve.
It's built into the unit price because it's sitting as that extra profit in the asset value. And to get the unit price, we take the asset value divided by, or net tangible assets divided by number of units on issue. So if we go back to that simple example before, if I had $1 million, if I had 1 million units at $1 each, and we took those 1 million units and we bought one property, and it was worth $1 million, and 1 unit equals $1, and then the exchange rate went to 50 cents, we'd have $2 million of assets, and we'd have 1 million units on issue, and so our unit price would have gone from $1 to $2. But so we've got, it's implicit in the unit price, but when we look at our profit and loss, there's no profit. And why is there no profit? Because we, on our equity, we've got $1 million of issued units and $1 million of foreign currency translation reserve and $2 million worth of assets. So that just proves to you that it's already sitting in the unit price. It's not an additional profit you're going to make.
Yeah. Okay. Thanks, Steve.
Good on you, mate. Catch you next time.
Yeah.
Let's go to Kate Harris. Wow. Good to see your hand up, Kate. Nice to see you online tonight. I think you're there. Did you want to say something, Kate, or did you just put your hand down?
No, that was an accident. Hi, Steve. How are you?
Well, there are no such things as accidents, but it's nice to hear from you. I'm hanging in there. I do have a couple of health glitches at the moment, which are not good. Nothing that's going to kill me, but I had some ear surgery, and I'm sad to report that there's been some unexpected consequences from the ear surgery, which have not been fun to deal with. But life goes on, and hopefully they'll settle down. We'll have to wait and see.
Well, I hope you feel better soon.
Hey, just pray for me. I know you're a praying type, so if you can pray for me for perseverance and also healing, and anyone else who's a praying type, I would really appreciate your prayers going forward. But anyway, it's nice to hear from you.
You too.
Don't be a stranger. All right, I have Yan Ding. Are you there? I can hear you there. Yan Ding. Oh, last chance. Nope. Didn't realise that you were there. Let's go to Mark Tatum. Are you there, Mark?
Yeah, hey Steve, how you going?
Good evening.
Can you hear me?
I can.
Okay. I was just thinking about the performance aspect you were talking about, and if you were redistributing, if you were reinvesting your distributions back into the fund, does that mean that your unit price will still go down? Because you're not actually taking any money out, you're not actually getting any of your capital back.
Yes, and no. Your unit price will net overall not change, but you've got to understand the transaction side of a distribution and a reinvestment. So your cost per unit is you don't buy one unit at $1 and then another unit at $2 and end up with 2 units at $1.50. You've got your one unit you bought for $1 and one unit you bought for $2. So the profitability of each tranche of units that you've got is different.
Okay.
So that's why it's not a simple answer to your question.
Right. Okay. I was just trying to work out if I was to like take money out of the fund, like how I'd work out roughly how much I've got. I was just reading the statement. I couldn't really figure out exactly what I've made or what I haven't made.
You almost need a spreadsheet, much like if you've got a dividend reinvestment plan, which says on this date I bought this many units at this price, and keep a ledger of all the different units you own, adding up to the total number of units and their cost base.
So basically, if I've got say 100,000 units at $1.20 at what they're at now, that doesn't necessarily mean that all those units are worth that price. They could all be worth different values depending on when it was reinvested and how much they were worth at that point.
And to work out any capital gain or loss, you usually do the units that you bought first, sold first. First in, first out.
Okay. Righto. Okay, I'll have a look into it.
All right, good luck, buddy.
No, thank you.
Let's go to Adam Newman Coates. Hello, Newman.
Hello, Seinfeld. How are you doing apart from your ears?
Yeah.
Sorry to hear about your ears.
Yeah, I was sorry to hear about it as well. Well done. Nice pun.
Is it worse with the headphones or is it irrelevant?
Strangely, I've been thinking about that as people have been talking. No, I wouldn't say it's worse. Yeah, but let me not bore you with my medical problems. How can I help you tonight?
Fair enough. I'm well. I had a couple of questions. One was regarding the redemptions. Do you guys try to forecast what you think will be there and put a set-aside amount, or is it more of a function of we've got this amount of cash that we can use as redemptions and then we allocate that money?
Yeah, it's a bit of both. We don't want to disappoint anyone by saying that we haven't set aside enough money, but we don't want to end up in a situation where the people that want to stay in the fund are in any way compromised by the people who want to get out of the fund. So we try and set, I mean, last year was one of those years that was just like, this year things are a bit more stable. So, if we had to top up the cash by a little bit more, we could, and no one would be no one would be put out by that. But $7.5 million is still a fair chunk of cash. So when Devendra and I got together and we recommended to the board how much money to set aside, we did cash flow modelling between now and the end of the year, looked at what our needs would be for cash consumption versus the rent that we're going to get in versus distributions that we wanted to pay. And then really a number dropped out and we looked at that number and said, how do we think that's going to be? Is it too low? And if it was too low, how do we find the extra cash to top that up? And the short answer is we ended up at $7.5 million.
Great. Well, it sounds like it's coming in much less than we expected, which is good news.
Things can change.
My other question was, yeah, of course. We've still got 2 weeks to go, so who knows? And I'm sure a lot of people are waiting for tonight to see what their thoughts were. You mentioned a few times that it's a seller's market. Should we be looking to sell more now if it's more of a seller's market rather than waiting for a year or two?
Yeah, possibly. The downside of selling more now is we're trying to manage. Remember, I said we need a certain number of properties to remain positive cash flow. If we sell more and more properties, then our costs will be greater than our income, and we'll be in a negative cash flow situation, which then speaks to solvency. So well, so what? Why don't we just sell more and wind the show up sooner? That's not a problem, other than it then creates a problem, because we've got properties that if we've borrowed against, and if we repaid that debt, there'd be hundreds of thousands of dollars worth of repayment penalties. And then we've also got a management team in the United States that we've made representations to about their job security and how long the fund's going to be going. Because one of the reasons for painting this structure and this plan out to 2025 gives them some degree of job security. And that's important to be transparent with them and let them know what's going on, and to consider incentives to encourage them to stay until the end of the fund. So
makes sense.
It's not just a simple, unfortunately, scenario of, hey, now's a good time to sell, so let's sell. Because we've got a plane full of passengers, and the passengers on the plane are the investors in the fund. Obviously, the employees of Plantation Capital Limited, me, the directors, the employees, of Senizo, the tenants. Like there's a lot of people on the plane, and some people may want to land 10 minutes earlier, but we've got to do what's best for everyone on the plane to realize the best value in the portfolio overall. Now, if people don't want to be on the plane until the end, that's okay. There are these annual redemptions, which is your window to grab a parachute and jump out and safely float back down to earth at this point in time. And that you can do that. But if you do want to stay on until the plane lands and pulls up to the gate and everyone hops off, my hope, and again, remember, earnings forecasts are fraught with danger, but my hope is that there will be a material upside that you will realize, which is the difference between the appraised values in the portfolio and the values we end up selling for. But only time will tell whether that's the case. One of the things that I can say, and again, not wanting to give anyone any advice on what they should do, is recently I looked at some other property funds that were on offer at the moment. And the conclusion that I came to for me was that if the fund offered the opportunity to invest more units, I would buy more units in this fund. I personally believe the narrative around that extra value, the strength of the US economy, and the belief that the Aussie dollar is overvalued given what China's trying to do to us and iron ore prices and all the rest of it, I personally would rather have more of my own money invested in this fund than taking another chance with another fund that I didn't know about. But I can't buy more units in the fund because the fund is closed. I can only reinvest my units. But I, for one, based on the financial statements that you have in front of you and everything that I've talked to you about tonight, I am not looking to redeem any of my units at this point in time, because I don't know what I would do with the money. I don't know. I don't need more cash. I have cash reserves that are sufficient for me. I need the return. That's what I want. I want my money deployed. But then everyone has to make up their own mind, don't they?
100%. 100%. I appreciate that. Hey, I might have missed it before. If I could have one last question. There was mention of a fire at Tara Boulevard.
Shop Satara went up
You
in
sound like a
smoke.
bit of
The
fun,
Mexican restaurant caught fire.
oh, is that what it was? I was intrigued to see what it was. I mean, I saw in the report that it was all taken care of and you still had a little bit of finishing up, I think it was. But,
I think it was
yeah, I was curious as to
I think
what
it might have been
happened.
$1.5 million in damage. So good thing we had insurance. We ended up paying, I think it was a $5,000
Yeah.
deductible. Plus they covered our rent for 12 months that we didn't get. I think it was 12 months.
Wow.
So we've got a shiny
Wow.
new
Wow.
part building and the rent covered, and that's expensive tacos. That's why that's why you have insurance. If you can't afford insurance, you can't afford to be an investor.
Yeah, flaming mojito.
All right, mate.
Thanks, Steve. Appreciate it.
Good
Keep up
night.
the great work.
See you, Newman.
See ya.
I think we heard from you, Mark, didn't we? And we've heard from Newman. So I've got Mr. Peter Skerr. You're next, Pete.
G'day, Steve. How you doing?
Hey, it's nice to hear your voice as well. I love catching up on these updates and hearing from people I don't hear from very often. And COVID's a bit of a bummer. You can't run events really, and I don't get around like I used to. So yeah, it's great to hear your voice too, Pete.
Thanks, Steve, and hopefully your ears do improve and you do get well soon. I would pray for you. I'm not quite that, but
I'm not unwell.
I'm thinking of you.
There's no sort of health related drama. It's just that my hearing, which was supposed to have been improved, has actually deteriorated. So it's not something that's going to kill me or require any kind of chemotherapy or anything else like that. It's just I had an ear operation which was designed to improve or supposed to improve the hearing in my left ear, and it hasn't, and it's actually then caused some unpleasant consequences about the quality of my hearing in that ear, which are playing out. But like I said, it's other than that, I'm just dealing with COVID lockdown like the rest of us and trying not to eat too much chocolate, which some days is hard.
It is. All right. Sorry to hear that. So I had sort of two questions, Steve, and you may have covered it because I joined late, but I just sort of was intrigued on how you're going to handle if you had, say, $75 million of funds under management and that then reduced to half that, say, or 25 or whatever number you want to pick, that your obviously your percentage administration fee is going to, relatively speaking, increase, and what the sort of how you are looking to handle that. And then tagging on the back of that, which might answer it, I was wondering, is there a potential option to sell the entire assets of the fund to another property fund based presumably in the States?
Okay, answering the second question first, because we've thought long and hard about that. The answer is it's unlikely that we could sell the entire portfolio to another single fund. And that is because we have a mix of your more mum and dad type investments, which are your higher yield, higher management aggravation, and more of your institutional type assets. And one buyer tends to want one or the other rather than both. So we could probably split off the mum and dad ones and sell them individually in the market, but have a core of maybe 4 or 5 assets that we sell to an insto. So it wouldn't be all or nothing, but it could be a part of that strategy that we end up. For instance, the assets that we have in Peachtree Corners, notwithstanding 350 Tech was one of them, they would make a really good portfolio for an institution because they're high B, low A class assets, all in one area that are institution grade. Something like Hanson Street, which is a but ugly commercial property in Fort Myers, which looks something like a end of world bunker made of concrete. It's hard to see an institution that would want to buy it, but a local investor / owner occupier in one of the spaces would eat it up for breakfast. So yeah, it's a bit of a combo. As for the other situation, what's actually going to happen is that the management fees for the fund are going to go down and down and down as time goes on. And that's okay, because I look at the totality of the fund over its life, not just how much I get paid in any one period. So there will come a time towards the end of the fund's life where I won't be paid much money, which because there'll be less and less funds under management, which of course won't mean I'll be working any less hard. It just means that I would have been sort of paid yesterday for the work I'm doing tomorrow. And I've known that from the start, and that's okay. Yeah, that's the answer that I got for you. But there'll come a time when the portfolio won't be positive cash flow anymore, because we will have sold down assets and our rent won't cover our expenses, which is why I've set aside a maximum 2-year period to sell down the property portfolio and to gradually reduce staff and pay people out bonuses, retention bonuses and that kind of thing. And as I say, bring the plane into land, soft landing.
All right, excellent. Thanks, Steve.
Nice to chat, Pete. Good night to you. All right, we're nearly there. I've got Wayne Clinton. You're next. Hi, Wayne. Hello. You there, Wayne? Oh, maybe you didn't realise.
Hello.
Yep, I've got you.
I am here. I didn't realise that. End up. But just been listening to the conversation. Obviously, I'm pretty happy with how things have gone over the years, and I got in way back nearly 10 years ago.
Crazy, isn't it? How time flies.
It's been a journey, and life goes on, and it's pretty exciting. So I just want to thank you for your involvement with it and your commitment to seeing it through to the glorious end.
Amen. Well, may God continue to bless it and bless us. Thanks, Wayne.
Absolutely.
All right, we have, I'll just pop Wayne's hand down. Let's go to Gina. You're next. Whoop, maybe Gina has decided she doesn't want to have a chat, so I will go to Gossie.
Oh, sorry, here I am.
Oh, there you are.
I'm here.
Let me just answer Gossie's question, then I'll come back to you. Gossie asks, leasing commissions are higher than expected. Can you give more info? Remember, Gossie, that I was mentioning around 10% vacancy being par, and our vacancy is functionally down to about 4%. Well, after the pandemic, we had slightly higher vacancy, and we gradually got around to leasing up that extra space. So that has resulted in higher than usual leasing commissions. That's the background to that one. But Gina, over to you.
Yeah, hi, Steve. Yeah, thanks for everything. And I love checking in on the reports. I was just wondering what your feeling is around, when quantitative easing sort of starts to taper and the Fed gets around to sort of raising rates again, and your comments on the current inflation in the US, because it's gone up to like 5.4%. What are your feelings on that? And just, yeah, what's your market sort of update around that? And are we at risk of higher interest rates?
Not on our portfolio, because our interest rates are fixed. So we're not in any danger of interest rates spiking on our debt. Remember, economics is more art than science, and people think that economics is accounting, and it's not. So what I suspect would happen is that there's a lot of debt out there, and that debt has created asset bubbles, and that's a downside risk. But as the Fed takes its foot off the accelerator, and as and when interest rates start to rise, there should be improved strength in the US dollar. So it acts as a bit of a counter lever, because if we have property values perhaps soften a bit, we should make up foreign exchange gain by the US dollar getting stronger. So I don't think it'll be all upside or all downside. I think the mix between how the fund makes its money may shift a little bit away from capital gains to currency gain. I could see that happening. But the short answer is I don't know, because I think we're so far off charted territory here that we'll all just have to wait and see.
Yeah, it's interesting time. Yep. And are you buying Bitcoin?
I have not bought a
I think you
single
answered that last webinar.
I have not bought a single unit of any cryptocurrency ever, and have no plans to, because I see it as a giant Ponzi scheme that people don't and can't really understand where the value is. You can't see it, you can't touch it. Someone says it's worth $50,000 a unit one day and $30,000 the next. It just doesn't make sense to me, and I only invest in things I understand and can make sense of. So yeah, no,
Yeah,
not for me.
that's what my accountant says too. Exactly that. Okay, thanks, Steve.
Good night. All right, friends, I am just about out of gas, if that's all right. So let's finish off with Simon, and apologies to Roman and Thomas. I'm not going to be able to get to you tonight, just running out of time. So Simon, over to you first, if you're there.
Hi, Steve. Thanks again for the detailed update. Can you hear me?
Yeah, I gotcha. You're welcome.
Hello. Oh, good. Thanks, mate. Just towards the end of the presentation, you talked about the FX gains that you've sort of seen in recent times and potentially distributing those. Was that something that you were thinking about more in the near future compared to, sort of around 23, 24?
We can only distribute the currency gains when they are realized, and they'll only be realized when the properties are sold, or if we refinanced those properties and brought the money back over from US dollars to Aussie dollars. So until then, they just sit in that foreign currency translation reserve.
Okay, no worries. Thanks for that. Appreciate it.
Yeah, I mean, Simon, we've covered a lot of territory tonight, and what I covered was actually reasonably advanced accounting, the notion of foreign currency translation reserves and performance and distributions and unit price. Hopefully it made sense to you and to others tonight. It's nice to be able to explain it. Of course, I don't know if you know, I used to teach accounting to non-accountants, so I've used a bit of my teaching background there tonight to try and explain those concepts to you, and hopefully it's landed. If it hasn't, if you didn't understand it, don't feel that there's something wrong with you. They are complicated, complex topics. You're welcome to watch the recording of this webinar again, and I will update the notes for any glitches that I may have inadvertently put on those slides. Well, that brings us to an end. Why don't we finish off with a word of prayer and wrap it up? Thank you, Lord, for tonight's webinar. Thank you for the inspiration and the thought process of putting the slide deck together, and for the words that you've put in my mouth as we've gone through tonight's presentation. Pray for those people who are considering the redemption, and pray that you would grant them wisdom as to what's the best thing for them to do, and that they would have a peace about the decision that they make. Pray for your continued Holy Spirit guidance for those of us who are running the fund and looking after the investments, that you would bless us with making wise decisions about the way that we invest, and when we wrap up, and conversations that we have, that we continue to protect the money that we're entrusted with and continue to grow it. Help us to be good and faithful stewards and servants. Pray for me, Lord, and my ear, that you would heal me, and that you would give me the perseverance to hang in there through sometimes tricky times. And we thank you, Lord. We thank you for the staff of Plantation Capital and Senizo. We thank you for Rich and his team, and Devendra and his team. And we ask that you would continue to empower them to do that job. Until we meet up again, Lord, help us to manage COVID, to be safe, to be healthy, to be people who encourage, and not people who get consumed by fear or doubt. We pray in Jesus' name. One and all say amen. Good night, friends. And for those of you of the recording, thanks for watching the recording. I'm glad you stuck through to the end. I look forward to doing another update when I have more information to share. Until then, goodbye. God bless.